Right now, we are staring at a price level that has defined the entire US dollar to Japanese yen narrative since 1990. The Bank of Japan just dropped a bombshell this morning. A new trend inflation gauge has come in above target, flashing a signal that the doves inside the BOJ can no longer ignore. Yet the market is buying the yen weakness with both hands. Every single time frame I am watching, from the 1 hour to the monthly, is screaming strong buy. That is not a typo. Monthly, weekly, daily, 4-hour, and even the 5-hour view, all aligned bullish. And that alignment is exactly the trap. When the consensus is this crowded, the move that destroys the most accounts is not a breakout, it is the violent reversal that comes after the breakout. There is one danger zone and one hidden opportunity today. I will show you both. Stay until the end, because I am giving out 3 exact entry and exit levels you can program into your platform right now, and I need you to see the invalidation number that will separate the winners from the wreckage. Here is your instant market verdict for today's session. The bias is trending higher, but we are operating inside a late-stage momentum extension, not a fresh impulse. That means trend trades must be treated as scalps with extremely tight definitions, and counter-trend entries are only for the fastest fingers. Write this number down, 158.63. If US dollar to Japanese yen trades below 158.63 on a 4-hour closing basis today, the whole structure shifts from strong buy to a topping pattern. That is your invalidation line. Not 158.80, not some intraday wick, 158.63. That level is the last higher low the bulls have defended, and it aligns with the MA20 on the daily chart, which has held every pullback for 3 weeks. Below there, we are suddenly talking about a false breakout and a fast move back to the 157.30 region. So if you want one level that tells you to stop being a bull, it's 158.63. The market does not care about your opinion. It cares about that number. Let's go deep into the technical structure, because what the chart is showing you on the surface is a lie. Most traders look at US dollar to Japanese yen at 159.30 and think, we are inches from 160, the path is clear. That is the retail vision. Institutional algos see something completely different. Start from the top. On the weekly chart, we have a flawless sequence of higher highs and higher lows going back to the 140 handle, and the moving averages are stacked perfectly bullish. The 50-week average is near 151.80, the 100-week at 146.50, and the 200-week all the way down at 136.20. The gap between price and those long-term averages tells you this trend is mature, extended, and loaded with profit. On the daily chart, the MA20 sits at 158.64, the MA50 at 158.34, the MA100 at 157.37, and the MA200 at 155.68. Notice something critical. The distance between the MA20 and the MA50 is only about 30 pips. That is extraordinarily tight for a pair that moves 150 pips a day. When short-term and medium-term averages compress like this, a volatility explosion is mathematically inevitable. It is the coiling of a spring. The MACD on the daily is still positive at 0.160, but the histogram bars are no longer expanding. They are flatlining. That is momentum exhaustion hiding in plain sight. The RSI on the 14 period is at 57, not overbought, which means there is room to run higher before an extreme reading kills the move. That is exactly why the trap works so well. The RSI gives permission to buy right before the rug pull. Now drop down to the 4-hour chart. Here is where the real game is being played. Price is oscillating inside a tight band between 158.80 support and 159.23 resistance, with a lit extension at 159.40. The 5-hour trend shows a series of small-bodied candles with long upper shadows near 159.23, the same level that capped the Tokyo session. That is absorption. Institutions are selling into the bids, capping the topside to build a liquidity pool above 159.40. And directly below, The MA20 on the 4-hour is at 158.64, perfectly matching our daily MA20 and the critical support I mentioned. The 60-minute chart tells the intraday story. The MA20 at 158.64 is acting as a magnet, with price oscillating around it. The 60-minute MA200 is at 155.68, useless for short-term guidance, but it reminds you how far the market has stretched. The MACD on the 60-minute is curling flat, no conviction. What you are witnessing is the final stage of a stop hunt in both directions. Above 159.40, there are guaranteed stop losses from early shorts. Below 158.63, there are guaranteed stop losses from late longs. The market will likely take both sides within the next 48 hours. Your job is to not be the liquidity. Now, weave in the crosser set link because it is screaming louder than the US dollar to Japanese yen chart itself. The Nikkei 225 is struggling to hold its intraday highs even as the yen weakens. Normally, a falling yen boosts exporter stocks and lifts the Nikkei. Today that correlation is breaking down. The Nikkei is showing relative weakness, a subtle risk-off whisper that the yen might be about to strengthen sharply on a BOJ policy shift or an intervention event. When the Nikkei fails to rally on yen weakness, the smart money starts buying yen puts on equities and yen calls on FX. This divergence is the early warning system for a violent mean reversion move in US dollar to Japanese yen. Keep your eyes on the Nikkei futures during Tokyo hours. If the Nikkei starts falling while US dollar to Japanese yen is still above 159, the trapdoor is opening, now the fundamental driver and why the last 24 hours changed the game. The headline reads, BOJ's new trend gauge shows inflation exceeding target. This is not a minor data point. The Bank of Japan has been deliberately vague about when it will normalize policy, always hiding behind the excuse that underlying inflation is not sustainable. This new gauge was designed to measure the breadth of price increases, and the fact that it overshot the target means the internal debate at the BOJ next week is no longer about if they hike, but when. The market initially bought more dollars on the news because it interpreted the data as just another number, but the yen bears are missing the point. If the BOJ signals a reduction in bond purchases or a July rate hike at the upcoming meeting, the yield differential between US Treasuries and JGBs will compress faster than a vacuum. The Ministry of Finance intervention threat, which I call the intervention ghost, is now backed by a fundamental reason to allow the yen to strengthen. That is new. Prior threats were empty because inflation was still fragile. Now the data gives them cover. The 1 to 2 week directional lean is therefore a blow-off top into the 160 psychological level, followed by a sharp, news-driven reversal. The event that invalidates the bearish reversal thesis is a daily close above 160.50 with a Nikkei 225 making fresh highs on the same day. If that happens, the intervention ghost is dead and the trend extends to 163. Until then, assume every spike above 159.40 is a liquidity grab that will be faded with size. Most people will skip this next part, but this is where money is made. Keep watching. I am going to lay out 3 precise trade strategies, each with exact trigger levels, stop-loss placement, and profit targets with risk-reward ratios. This is not theory. This is your operational plan for the next session. Strategy 1, the sniper. This is the conservative approach. You wait for the market to do the hard work. The trigger condition is a 4-hour close above 159.40 with a decisive bullish engulfing candle, and then you wait for a retest of 159.40 as new support. That is your entry zone. Only enter long if the retest holds for at least one full hourly candle body above the level. Your stop loss goes at 159.00, exactly 40 pips below entry, just under the breakout structure and below the MA20 on the 4-hour. Target 1 is 159.90, giving you a 50 pip gain. Target 2 is 160.50, a 110 pip gain. Risk reward on the first target is 1 to 1.25, but by taking partials and moving your stop to break even after target 1, you turn it into a risk-free runner. What voids this setup? If the breakout above 159.40 happens but fails to hold on the retest, and price slides back below 159.23 within the next 4 hours, the breakout was a trap. Do not re-enter long. Strategy 2, the active trader. This is for those who want to participate in the current range before the breakout. The entry condition is a bounce off the support band between 158.80 and 158.63, confirmed by a 60-minute bullish pin bar or a strong bullish engulfing candle. The reasoning behind the stop loss is structural. Place your stop at 158.40, exactly 23 pips below the 158.63 invalidation level, giving the market room to breathe but proving you wrong if the last higher low breaks. Target 1 is the pivot resistance at 159.23. Target 2 is the major ceiling at 159.40. Once target 1 is hit, immediately move your stop loss to break even and close half the position. This is a classic pullback trend strategy that exploits the stacked moving averages that are all pointing up. The MA50 on the 4-hour at 158.34 is your ultimate line in the sand. This setup works because the momentum is still strong buy on the higher timeframes, and you are buying value at the demand zone. Strategy 3, the aggressor. This is a countertrend, high-risk play that only works if you are obsessed with losing small. The setup. Watch for a spiking move above 159.40 that immediately gets rejected with a 15-minute bearish engulfing candle closing back below 159.23. That is the exhaustion wick. Enter short at the close of that 15-minute candle, with a stop loss 5 pips above the spike high, usually around 159.55. Your target 1 is 158.80, and target 2 is 158.63. Risk-reward on this can be 3 to 1 or more because your stop is tight. But listen to me clearly. This is a fade against a multi-time frame strong buy trend. If the BOJ intervention ghost materializes, this trade becomes a monster winner. If not, you will be stopped out for a small loss and move on. Only for those who know how to manage risk aggressively and never add to a loser. Let's see how aligned we are. Type your US dollar to Japanese yen range for tomorrow in the comments right now. I read them every morning, and the best call gets pinned. Give me your high and low, and I will see if the community is reading the same trap. Never risk more than 1 to 2% per trade. No open positions through high-impact Tokyo or US data events. Stops are non-negotiable. If a trade invalidates, you exit. No exceptions. So let's wrap this up and prime you for the next session. The most critical level on my screen right now is 158.63. A daily close below that number opens a fast path to 157.30 and tears the bullish thesis apart. As long as we hold above, the trend is your friend but the trap is your enemy. Tomorrow's focus will be the Tokyo fix and any BOJ board member comments that leak during the Asian session. If a wire hits talking about a rate hike discussion, the yen could reprice 100 pips in 10 minutes. I will be watching the Nikkei futures from the open. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. I exposed a major funding rate anomaly that signals a liquidity hunt. Click the end screen and go straight there. Smash like if this analysis gave you a clear, executable plan for today. Subscribe and hit the bell because I cover all 8 key assets every single session, and you do not want to miss the next volatility event. I'll see you in the next one.